Hi there, I'm Dan Denning from Phillip Publishing, and welcome to another one of our strategy sessions. Today my guest is Phillip J. Anderson. Some of you might remember Phil from our 2009 conference, Australia in the Red, and Phil spoke at that conference about real estate. But today we're going to talk a little bit about everything. We're going to talk about stock market cycles, economics, and of course we're going to talk about the Aussie property market, which is a hot topic with our customers. So before I get to Phil's questions and we get into the presentation, if you want to know more about what he's doing, you can go to his website, which is www.phillipjanderson.com.
And that's the blog, yeah, or businesscycles.biz.
Or businesscycles.biz, that's the other one. And we're going to be talking about this book during today's conversation. You can get it online. You can also get it in bookstores here in Australia. It's Phil's book, The Secret Life of Real Estate. So if you're particularly interested in the conversation about where Australian real estate comes from and where it's headed, that's the book. Now Phil's great. He's not afraid of controversy, so I thought it would be good to have him on because if you're a regular reader of the Daily Reckoning or you subscribe to Phillip Publications, you'll know that we're probably not property bulls. But I wouldn't describe Phil as a property bull or a bear. He's just got a very intriguing outlook on how markets work. And that's what we're going to focus on today. And I think you might be pleasantly surprised that it's a very optimistic vision of the future, not just for the property market, but for equity markets as well. So it should be a welcome dose of optimism. But before we get to all of that, I just want to go over a couple numbers with you, Phil, because I think we've picked an auspicious day to record this presentation.
Yeah, indeed.
Today, the Dow Jones Industrials closed higher for the 9th straight day in a row. It's the longest winning streak for the Dow since 1996, so that's 16 years since the Dow has done this. It's, of course, now it's at an all-time high of 14,455, and the S&P 500 is not far behind now. It's 11 points away from its all-time high. And if I understand your work correctly, what's happening in the U.S. markets right now probably has some bearing on what will happen in the Australian property market. But before we get to that, why don't you tell our readers a little bit about Economic Indicator Services and yourself?
Yeah, hi Dan. I've always had a bent in economics, and I've always wanted to really, I've always wondered whether you can actually forecast the future. So, you know, good maybe 1990 or thereabouts, I left the business that I was in as a family embroidery business, and set out on my own to do some inquiries about whether, from an economic point of view, you can actually forecast the future. When I did that, I was fortunate enough to read a couple of interesting property books, one by Fred Harrison called The Power in the Land. And that book was a book written in 1983 that was calling for a real estate recession in the very late 1980s, early 1990s. And I was reading that book in 1991, and here we were, right in the middle of a recession. So I thought that was interesting. So what I then did was, I'm always sceptical of a lot of what I read. So I thought, all right, well, I'll examine the US markets and see if they've got the same sort of cycle. And I came across a few books that clearly demonstrated that there was some sort of cyclical behaviour in the whole economic sphere. Mm-hmm. I had lived through a big boom in Australia in the 1980s, a really big bust in Melbourne in the very early 1990s. I thought, well, you know, if you could forecast that, I thought to myself, if I could forecast that, I could retire early. That was essentially what I was trying to do. And I worked out that there's a very clear, certainly in the US, that's the market I studied first, mm-hmm. but it's obvious Australia follows what the US is doing. There's a very clear cyclical behaviour in the US economy. It staggers me that nobody else seems to, at the time, certainly seemed to be able to see this. So I just kept on researching, I kept on studying. The significance of that was in the very early 1990s, we're at the bottom, but the US markets seem to be recovering quickly. Mm-hmm. US markets in 1992, 1993, thereabouts, and into continuing 1994, the US stock market, the Dow, went into all-time new highs, and it was just to me, it seemed all up from there. And I remember vividly that early 1990s, absolutely everybody was still bearish in Australia. They were saying that property would never recover and that you'd never get your money back, and people were, things were collapsing right around us. And I said at the time, because our family was involved in some property then at the time, and it just looked like the American market was going to continue up. The Dow broke into all-time new highs, and away we went. And it was just, from that point of view, you could see that the cycles are there, history seems to repeat. And here we are today with a similar sort of thing.
Well, you've mentioned this before in some of your other speeches, that economists generally are made uncomfortable by your theory because the conventional wisdom on Wall Street or in the finance business is that the market is a random walk, that it's not cyclical.
Well,
and you can't interpret it that way.
I'd differentiate a couple of things there. For people who've studied economics, if you go to school, if you go to university, if you've been through the academic field, the academics themselves, they seem to have this opinion. In fact, all the research they say proves it, that the market's random. That there isn't this cyclical behaviour, and that you can't necessarily, because according to them, all the markets built in, all the information is built into markets. Therefore, you can't extract any inefficiencies from it. So, what's the point of trying to forecast it? Because it's all random. And I think that was Eugene Fama brought that out in the 1950s, and then Burton Dalziel, I think his name was, he wrote. Yes, he wrote Random Walk Down Wall Street.
Yeah.
And that myth perpetuates. But on the other hand, if you talk about market traders, the good market traders that have been around a while, and people on Wall Street, they're much more prepared to accept or examine a thesis that might say they're cycles, because those guys will say, well, if there's money in it and it gives me an edge, I'm prepared to accept that. So I differentiate there. But certainly the academics, they're hopeless. And the economists, they've just got, the real economists, they've just will not admit of a cycle at all. And I think people are seeing now, and certainly your readers, it's clear there's some sort of cyclical behaviour.
Yeah.
That's the intriguing thing. The question is, after that, which I was asking myself when I was doing my research, can you time that cycle?
Right.
And the same thing really, can you forecast that in advance? Because if you can forecast it, if you can make some sort of decent timing on that, then you're able to adjust your economic behaviour and your investment behaviour to take advantage of that. That's the real key. That's the question I wanted to ask myself when I was doing all the research. I found out that essentially in the longer time frames, not over a daily basis, but over a monthly, yearly basis, you can get these repeats. You can time it. And that's where it starts to get interesting. It's certainly interesting for your readers and your viewers when you can start to make some decent investment decisions based on repeat behaviour that you can see in the cycle. That's the interesting stuff.
Yeah, well, it's very interesting. And if I got it right, the one that, there's three of them that you talk about. There's Kondratieff, there's Gann, and then there's this 18-year cycle.
Yes.
And why don't we start with that one,
Yes.
where you can explain a little bit where the data comes from, what
Yes.
the cycle is, and then maybe after that, where we are
Yes.
in that 18-year cycle today.
Well, I'd even start with something that's even a bit more obvious for people. The first place I start is what's called in the US the presidential cycle. That's basically a 4-year cycle, and I won't dwell on this, but I think people can see it's clear that every 4 years there's a presidential election in the US. It seems to be that the year going into the presidential election, the president-elect, he wants to get re-elected. The incumbent, certainly, as we've seen last year. So I think behind the scenes, the president will talk to the Fed, and they'll act in concert, and they will attempt to at least make sure that growth is continuous throughout the year before the election.
Mm-hmm.
And you can see once the election all takes place, and whether there's a new president or even the incumbent, the pressure's off to maintain the growth. So they're not so concerned about trying to keep the economy afloat all the time. Now that's over every 4 years.
Mm-hmm.
There is, as I've seen with my research, there's a bigger cycle than that. You might note that with the 4-year presidential cycle, that the cycle, in a sense, we had an election in 2008, but no matter what the politicians and the Fed were trying to do, 2008 was a down year.
Mm-hmm.
We had the similar thing in 2000 when there was an election there as well. So with the presidential elections, normally every year when there's a presidential election, the economy's up. We had the two exceptions, 2008, year 2000. The reason why you had those exceptions is to do with the larger cycle, which is the real estate cycle, the US real estate cycle in particular is what I've studied.
And that's the 18-year
And that's the 18-year cycle,
Right.
yes. And when I did the book, The Secret Life of Real Estate, actually when we did the second printing, we renamed it a bit. We called it The Secret Life of Real Estate and Banking because everybody was blaming banks for the downturns. But actually, if you really get into the book, you can see it's not just a finance question. The 18-year cycle it's a land question, really, at its heart. I won't go into that now, but the 18-year real estate cycle as such, it has a stand to be that that US economists, that the market itself, haven't seen this more clearly. Because when you study the history of the US, and I've done it in detail back to 1800, when you study it back there, it's crystal clear. It's blindingly obvious, and it just amazes me nobody else has seen this. Approximately, it's not every exact 18 years,
Right.
but every 18, 19, sometimes 20, the US markets take a huge tumble. Now, the reason why I talk to so many stock market people about real estate and say that the stock market people should understand real estate is because approximately every 18 to 20 years, the stock market tanks. It takes a huge tumble. And the reason why it takes a tumble is because it's a real estate-led downturn. And so that's the basic nuts and bolts. That's the outline of what you might call the 18-year cycle. Now,
Can I ask you one question?
Yeah,
Because
sure.
you said you didn't want to go into it, and we will go into it in more depth with your presentation, which I'll tell you more about later. But this is a really interesting point that you've made in your work, that a lot of people viewed the credit crunch as a banking phenomenon,
Yes.
that it was a collapse, a contraction in credit, and that's what caused stock
Yes.
prices to go down.
Yes.
But your claim is that that actually originates with the fluctuation in land values.
Yes.
The expansion of credit derives from
Yes.
land values. Is that right?
Dan, that's a really important point, and I'll give you an example of why that's so important. You cast your mind back. You might remember in about the year 2000, 2001, just a little bit after that, we also had a credit contraction, and the US went into recession just after that. But the credit contraction there, it was to do with banks, but it was really more it didn't involve the land value so much. So when we got it was sort of minor as well, and in fact it was really more to do with the stock market than anything else, and also the events that happened in the year 2001, where people sort of panicked a little bit, which is understandable.
Mm-hmm.
But in that era, back 2001, 2002, the price of property hadn't built itself up to such an extent where it was at an extreme. Right. Now bring yourself to 2007, 2008, where we get another credit contraction. So we get to 2002, 2007, 2008. And all people can remember is the credit contraction that we had in 2001. The Fed's like that, the president's like that, all the investors are like that. So they'll say to themselves in 2007, 2008, as things are tanking, the Fed will say, well, if we just manipulate interest rates and if we pump more money into the economy, things will be fine, because that's what we did in 2001 and it worked. Mm-hmm. And people by that stage, 2007, they've forgotten the behaviour that happened in 1991, where we had a really major downturn too. By 2007, we'd had real estate, which is in a sense based on the amount of credit that's available from the lending from banks. It had got to such an extreme valuation that when it turned and when it started collapsing, when that happens, it doesn't matter how much money gets pumped in by the Fed, people stop buying. And so prices continue to fall. And the reason why 2007, 2008 gets more serious is because when the prices of property start declining, and when the prices of that go lower than the value of the credit outstanding that the banks have created, mm-hmm. then banks have a serious problem. Mm-hmm. And that's the difference. That's why you have to understand the 18-year real estate cycle, because when you get the downturn, when the property prices start declining below the value of the bank credit outstanding, that's when we've got a serious issue. And that didn't happen in 2001, right. 2002. And that's the essential difference that people need to understand. And that's why it seems to me, in the history I've studied of the US, that phenomenon of real estate prices going below the value of the loans outstanding, that seems to happen every 18 to 19 years.
So this is a key question for where stocks are at right now, and I'm actually going to refer people to an article you wrote in 2000 in October of 2008.
That was my lead story for the UK's largest finance magazine, Money Week.
That's right, Money Week magazine, based in London. It's actually one of our affiliates.
Oh, really?
Yeah,
okay.
But they put Phil's story on the cover, and the cover story was called "Property Will Fall Until at Least 2011. Then U.S. Stocks Will Lead the Way." So I encourage people to read it. It's October 10th, 2008.
Yeah, it's on the web. It's easily accessible.
You'll get a very good introduction of Phil's key ideas. But really, the main idea for today's discussion is that you said back then that property prices in the U.S. would probably bottom sometime in 2010, but it might take them a couple of years to recover, and we would know when the recovery was coming by the behavior of stocks. Is that
of the stock market? Yeah, that's a good synopsis. It's if you study the history of these things, if you look back in the past, you can see clearly that what happens at the real estate lows. Real estate takes a long time to turn, but at those lows, you know that you're coming out of those lows when the stock market starts to recover. So clearly, you go back in history, 1991 and 1974, and every 18 years prior to that, as the real estate prices, actually they continue to go a little bit lower, the stock market starts to recover. Now, the reason that happens is, as we know, and I'm sure your readers are aware, the stock market is always looking 6 to 9 months ahead. Mm-hmm. So by the time the real estate's making its lows, the stock market, it's already discounting that information because it's public, the market knows it already, and it's looking ahead for the next 6 to 12 months to what might happen in the future. And as the stock market itself, over the last, say, after 2000, say during 2010 and 2011, the stock market started making higher bottoms. So that was the players in the stock market, that was their judgment that things had bottomed, things were starting to improve. Now the thing with that is, and this is what fools absolutely everybody that hasn't had experience in the market before, and it fools. In fact, it's a concept that's quite difficult to understand in a sense, unless you've been around the market a long time. The stock market starts making higher bottoms, which we got right through 2000 and 2011, but those higher bottoms happen on actually worse economic news. And that's what fools everybody. So unless you can learn to read a chart, and that's where I learned from the great W.D. Gann. Mm-hmm. If you get to read that chart, if you can read a chart effectively, the higher bottoms, even though they're on worse economic news, is actually telling you that the market thinks things are improving. And I've noticed over the years, except at the extreme highs, the stock market never gets that wrong. So once those higher bottoms were occurring, it was fairly clear to me that despite the economic news getting worse, and despite in the US property news getting a little bit worse, company earnings were improving. Mm-hmm. Therefore, when company earnings improve, the price of the stocks simply have to go up, and that's what's been happening over the last couple of years. That process has happened every single time, exactly the same way since 1800 in the US, and that's what I documented in the book. It's an astounding repeat. I can't understand why more people can't see this.
This is, I think, what's interesting about having Phil here right now, because the conventional view right now, and it probably would be my view, although I wouldn't describe it as conventional, is that the current high on the Dow is mostly assisted by liquidity from the Fed, so that it's not, the stock market is not giving you an accurate forward forecast of what's going on in the economy. But you're actually saying really the opposite, that you got to trust the market for what it's doing, and that the stock market making a new high is not the end. This isn't the high, it's the beginning of something even better. Is that?
Yeah, yes.
This gets crazy, by the way, so hold on.
The hardest thing to do really is as the stock market starts making higher bottoms whilst the economic news is getting worse, the hardest thing to do is to buy stocks. It really is quite tough, because all your emotions are telling you things are going to get worse. So 2010, 2011, the euro was going to collapse. Greece was going to default. The European Union would break apart. But when you've studied history, and this is the great advantage I felt I had in writing the book and then studying the history, I've seen that before. Mm-hmm. And right through 1991, 92, I can assure you, certainly in Australia and certainly in the US, property people in the US were screaming in 1991, 92 for demanding assistance from the government. You know, Trump was bankrupt and he was demanding all sorts of assistance. The news got worse. But despite that, the Dow went sideways at highs. I think it's around about 1,600, 1,700, something like that. It's an insanely low number now. Then it broke into all-time new highs. Mm-hmm. Now, the thing about this, which is interesting from my point of view to study, is that the Dow is now making all-time new highs at the very beginning of a real estate cycle. I simply, if we are to, it's not assume, but it's more than assume, but let's just use the word assumption. Economists, I'm an economist, we love using that word assumption, but assuming history is to repeat, and I demonstrate in the book, I give the reasons why history must repeat. Again, we don't have time to go into that today. Yeah. But history it must repeat, and it will repeat. As it continues to repeat, the Dow is making its all-time new highs very early in the real estate cycle. The real estate cycle will continue. Now, historically, when the US stock market has done that, it was 1993, it was 1975, 76 through there, again it was hitting those highs. And before that, you can date that way before that into the 1953, 1954, the beginning of the cycle then when the Dow went into all-time new highs. And back then, even in the 1920s as well, when the Dow again went into all-time new highs at the beginning of that real estate cycle, it forecasts another huge boom to come. So if history is to repeat, and I've been saying this for some years now, the stock market going to all-time new highs, we are on the verge of another huge boom, both in real estate, both in the US, both in technology, both in energy. And that being the case, it runs counter to the conventional wisdom at the moment, but this is what the market is suggesting. Now, having said that though, don't go away from here. You know, the Dow is due a retracement. It doesn't go up in a straight line. It has to go up and then it has to retrace. And so, later on in the year, in the next month or two, there has to be some sort of retracement. And again, when it makes that retracement, it could be quite a vicious retracement. It could collapse a few 100,000 points or two in a matter of weeks, which again will panic everybody, and people say, "Oh, we're back into other things." But again, it probably will just make another higher low, and then we're off and running.
Well, there's a lot of things we could talk about, and one thing I enjoy about this conversation in the work that you've produced in the last couple of years, that I agree with, by the way, is that cheap energy and innovations in materials technology are two really big breakthroughs that, independent of what's going on in the financial system, are very exciting. And for investors, they're incredibly exciting. Yes. So I share your enthusiasm. But when I saw one of your recent presentations, I wanted to ask you a question, and I'm not asking I guess I'm asking as a skeptic, because I'm not trying to disprove you. But
it's good to be skeptical. I encourage people to be skeptical.
Well, you made this point very well in your October 10th, 2008 Money Week article. You said that the bottom in the real estate cycle in previous cycles came usually with the liquidation or the collapse of a major financial institution. And then sort of credit cleared and the cycle began again. Now my question is that a lot of people would say that didn't happen in this cycle, that it was prevented from happening by central banks who expanded their balance sheet by an aggregate of $7 trillion globally. So instead of getting a market clearing price in real estate that really would have put a floor under prices and seen a recovery, you got the market kind of artificially resuscitated by central bank money. Now we are seeing signs that property prices have recovered in the US and certainly in London and some other the major markets. But is it your view that there was a bottom in real estate prices in the US in 2010?
Oh, Dan, there's so much I could say about that. Yes, it's right. Looking at the history, when you get to the bottom of the real estate cycle, it is the bank collapses that mark that bottom, and every 18 to 19, 20 years in the US, there's been these major collapses.
Yeah.
Now, what I've noted over the years is every real estate low point, the numbers just seem to get bigger, and the bank collapses just seem to be bigger and bigger, and the numbers just that are now massive that are involved in that. So yes, in a sense that every cycle happens different. They can't happen exactly the same way. Otherwise everybody would see it, and we'd react to it before it happens, and things would change a little bit. Plus, as well, they can't always happen the same way because you've always got the new technology developing, and so it's dealt with the same way. But the underlying cause is there. Yeah. On the way down, the numbers were so big this time, and the collapse happened, I think, sort of so quickly that the banks were collapsing on the way down. Yeah. Once we got to the bottom, I think the collapses had already happened, and so there wasn't a lot left to happen. That's the first thing. So in that sense, it was a little bit harder to see. But if you read the history in the book there that I've got, you pick up that history. The second thing about that really is that we do have an even larger overriding cycle, and this is what is called it's the commodity price cycle. In economics, it's called the Kondratieff wave. Right. It's a hotly debated subject in economics, again, because it's a bit cyclical based and academic economists won't admit of these cycles. But the so-called Kondratieff way, which is detailing a commodity price cycle, it's suggested that the commodity price cycle is about 54 to 60 years in length. Again, that's actually how I started my business back in the early 1990s. You can trace that history back to about 1770 or thereabouts. And as Nikolai Kondratieff, that's why the cycle is called the Kondratieff way, because it's named after old Nikolai, a Russian economist. He demonstrated clearly that commodity prices, they bottom every 60 years and they tend to peak. They tend to peak every 60 years. So it's 30 years up, 30 years down. The last peak we had was in the early 1970s. The last bottom we had was in the 1990s. We are, in my view, and if you've studied the K wave, people will probably, it seems to be reasonably clear, we're halfway through the up move in a commodity price cycle. This means that commodity prices will tend to stay high over the lifetime of that cycle up move, which is about 25 to 30 years. I think we're halfway through that, so commodity prices are going to stay high. Because commodity prices around the world will stay high, this allows, and I've demonstrated this again through some of the talks I've done, on the upside of the wave, the real estate downturns on that upside, so there's two during that up wave of 25 years, 30 years. The real estate downturns on that up wave are very sharp but short-lived, and we tend to recover very quickly. And one of the reasons why we recover very quickly is because of the relentless new technology and the invention that happens on the upside of a K wave, which Nikolai clearly demonstrated. Yeah. Commodity prices, should they stay high, and I think they will, that allows the economy to recover much quicker, because high commodity prices are hugely profitable for major parts of the world. So any commodity producer, any countries that produce commodities, the Middle East, Canada, Australia, they see a massive boom. And the thing about that is, and this is what economists will never tell you, and you'll know you've understood this process when you work out why it has to happen. At the end of the day, it's land prices that, at the end of the day, not over the course of a cycle, it's the land prices that take all the gains. Yeah. And this is the fundamental natural law of economics that academics just will not cope with this. But it's just a fundamental economic law. The gains that happen in society over the course of a cycle, they are taken by the land price. Right. And so when you get these big, huge booms in commodity prices, real estate recovers from a downturn really quickly. Or indeed, sorry to interrupt, keep talking, but right. Places like Canada, Australia, the Middle East, you get these. In the Middle East, you had a short, sharp move, but in Australia and Canada and places like that, real estate will never really collapse too much, because the high commodity prices keep people in work. Yeah. You know, they create huge wealth, and it's real wealth that happens too, and it's real jobs. Yeah. And people keep the jobs. You get unemployment that stays very low. So it's high job growth. People can keep paying their mortgages, so property really never really. I want to get to that point. It'll be our last point, because I don't want to. We don't want to go. We could go all day, but I want to get to it in a second. Sure. But I told you this was interesting, so let's just summarize. I think the three key points we've made so far that Phil's made, that U.S. real estate prices bottomed around 2010, and that the new high on the Dow now, the current high on the Dow, is not the end of the rally, but since it coincides with the beginning of the real estate cycle, we may be headed to much higher highs on the Dow. Yeah, not today, but over time. Over time. The second point, which will be welcome news to Diggers and Drillers subscribers, and really to everyone in Australia, is that if the K wave is accurate and we're halfway through the commodity cycle, it's not over. And I was very bullish, Dan. It's exceedingly bullish if it continues. That's good news for the commodity bulls. But the last point is probably the one you're going to spend a lot of time in a couple weeks talking about it in our 2-hour presentation. But the real subject is, how does all of this relate to Australian property prices? So we talked a lot about U.S. markets. We've talked a lot about long-term cycles. But what you've done with your work is you've connected these cycles to what people can expect from the Aussie property market. Yes. So without giving away what you're going to talk about in a couple of weeks, can you just briefly summarize where those first 2 points bring us with Australian property? Well, that's the for people in Australia, property investors in Australia, and people in the stock market. That's the essential question, and that's the exact topic that we'll be covering in the talk that you've asked me to give, and I'm looking forward to it. Australia follows the the American market.
Mm-hmm.
And one of the reasons I studied the American market so intensively is because I'm a UK and Australian property and stock market investor. So I spend half my time in both France, or I divide my time between France, the UK and Melbourne, Australia. US cycle leads, so if you can determine what's happening in the American market, it gives you a great clue, because you'll know the UK market's about 6 to 8 months behind the US, and Australia's about a year to a year and a half behind. So what happens in the US now will be coming to Australia, and Australia will follow that in the years to come. So it gives you a great ability to pretty much have a good idea what's going to happen next in Australia, simply by studying US real estate markets and some of the markets over there. Of course, Australia is turning to Asia now, of course. So we've got a new thing. History never repeats exactly. It rhymes, but it can never repeat exactly. We've got a new thing coming through with China and its development. So I'm going to talk a little bit about China and its cycle as well, because that's also slightly different. So we have to be aware of what's going on there. But essentially, by studying those things, it gives you a good idea of, it gives you clues as to what's coming in Australia next. And I'm very. I think I have an 11-year-old son at the moment, and gosh, I'd love to be 11 again. I think the future looks absolutely outstanding. The new technology coming through, what you can do with iPads and computers and phones and everything else, just absolutely amazing. And again, at the end of the day, real estate's going to take those gains. It's important that your readers and your viewers understand that, and that's what I'm going to emphasise in the talk. And I'll show them the property clock that I've developed. Once you get to know the reasoning and the cause behind that, you really can. I know this is, I know in the talks I give, it's really hard for people to believe first up, because they get so much rubbish coming out of academic economists and people like that. But when you see this clock, it's been the same dramatic turns since 1800 in the US. You can apply it to Australia. We follow for the same reasons, the same cause. You really can break it down year by year. As the clock turns, you can really see each year roughly what you can expect. And then after that, also, people come along and hear me talk. What I'll do is, as an extra towards the end, I'll relate that to what Gann called his financial timetable, which again breaks down the 18-year cycle, but he applies that to the stock market. It is astounding what Gann was able to do. I'll show people that, and then you can get that on a year-by-year basis. You can do some astounding planning. You really can. Now, I know in the future, it's obvious you can't know what's going to happen exactly, so I'm not saying you can, but you can get this flavour, you can get this sort of perspective. And again, as with the Dow breaking into all-time new highs today, and it happens at the beginning of a real estate cycle, it allows people to just make what I think are much better investment decisions.
Well, I think it's helped a lot of people today. I told you it was controversial, but I think it was also very interesting. And Phil's got so much material to talk about that we had to pick and choose what we could cover today. But as I mentioned at the beginning, one of the things that we're going to be doing shortly with Phil is he's going to be given a full 2 hours to present his case on real estate, the real estate clock, the 18-year cycle, the Kondratieff cycle, and the work of W.D. Gann. So we're going to record that and make that presentation available to you when it's done. So keep your eyes peeled for that. But Phil, thanks for coming in and talking
my pleasure,
to us.
Dan. It was great.
Appreciate it.
Good.
And good luck. We'll see you soon.
Thanks, Dan.
Thanks.